Okay, welcome everybody to episode 84 of the Volatility Barometer live stream. So thank you very much for coming. I very much appreciate all the support. Today, I definitely want to dedicate plenty of time to the open Q&A, answer all of your questions, and something that I always forget to say until the end of the video, but today, I'm going to remind everybody to please hit the like button for me. Definitely shares the video to more people who will want to see this type of volatility content. So don't super chat, don't send any money. Of course, my live streams are always free, but the price of admission, give me a like for me if you don't mind. Now, today we're going to cover one topic and then we'll get into the Q&A, but it's a pretty important topic, especially for VTS members, but whoever is not in the VTS community, of course, you're going to definitely appreciate this as well. I'm going to review a small change that we made with our UVXY broken wing butterfly strategy. It's called Volatility Trend. Now, there is actually a video on the YouTube channel already. If you just go to the YouTube channel and you scroll down, I'll show you what it looks like. It's this one right here. It says short UVXY profit. Go ahead and check out that video for an overlay of what the strategy is all about. But the small change that we've made recently is that now it's going to be functioning as an overlay. So in today's live stream, I'm actually going to cover what an overlay is, why this strategy in particular will act as a really good overlay. I'll show you an example of UVXY broken wing butterfly. We'll go over the allocation sizing. So lots to cover here today. I do want to remind you as well, if you want to see things in more detail, there is always a free trial on the website. So if you go to my website, you just hit the subscribe button. It'll take you over to this page and you can go ahead and sign up. Now you can see here, all monthly subscriptions receive a free 2-week trial. So you can check everything out. Once you subscribe to the free trial, there is no paywall beyond that. So you literally do see 100% of everything we do. And that will also include our full course library. Now, beyond just giving out the trade signals every day for our entire portfolio, there is also a lot of education involved as well. Tactical Volatility has a course. Our Iron Condor strategy has 30 videos in a mega course. We've got one on stock replacement. We've got a couple more. There's a welcome package. There's a volatility landscape that I just started building, so you might want to follow that one in real time. Couple more. We've got a volatility dashboard that I'm building, the total portfolio course. But the one we're going to be talking about today is this volatility trend strategy. This is a short volatility strategy, but the interesting thing here is that it has no upside risk. So it's very unique. You won't see this anywhere else. Of course, once I start making videos and live streams, you'll see a bunch of people copycat me. But this is totally unique to VTS. It's a strategy that I'm very proud of. And there is a full course. So right now there's 13 lessons. There will quite quickly be 16 because I've got some ideas for a few more here. But again, you can check out the free trial if you would like. Comes with all the courses, and you can decide after 2 weeks whether you want to commit. No harm. If you want to just unsubscribe, it's totally fine. We can still be friends, still hang out on the live streams. You don't have to pay me money to actually benefit from my work. But today, we're going to cover the volatility trend strategy. So you can start getting your questions in the comment section, and let's get started. So the first thing to say here, this is our portfolio. We call this the total portfolio solution. Now, right now there's 5 strategies. You can see over here the allocations. It says 25, 25, 25, 25, and 0. This is a 0% volatility trend overlay. That's what we're actually going to be talking about today. What is an overlay and why is this strategy such a good one? So the first thing that we can get into is a general definition of what you would hear in the investment community of what an overlay is. Now, this isn't necessarily my definition. I'll add to this in a second. But an overlay strategy is the use of derivatives to substitute portions of an investment portfolio or provide offsetting exposure or hedging. So that's a pretty generic sounding definition. I basically just Googled that. But I have a couple additional conditions that I consider an overlay strategy. Now, the first one is an overlay strategy should only utilize small portions of capital within the portfolio. And ideally, no additional capital at all would be required. Because really, if it does require a bunch of additional capital, then it is just another strategy within a portfolio. It's not really an overlay at that point. It's just, why don't you just allocate and call it a strategy? So an overlay should not be using any capital. And the second condition that I have is that an overlay strategy should have negative correlation such that including it does not add any additional risk to the overall portfolio. Again, if you're just adding something that is also directionally exposed to the same market environment, say as this one and these three, then really you're just adding leverage to what you've already got. You're just triple and quadrupling down on the market exposure that already exists. So an overlay strategy really should have negative stock market correlation and negative correlation to the rest of your portfolio. These two conditions are essentially what I consider an overlay strategy. Now, this is a really key point because when you think about it, there are many strategies out there that will perform just fine if the market cooperates. Right? There's a million short volatility strategies out there that as long as the stock market keeps going up, volatility will decay, and that person having the strategy can say that it's going to perform really well. But the problem is when the stock market goes down, of course, the short volatility trade suffers. That's actually the risk portion of a short volatility strategy. What happens when volatility spikes? That's what everybody is actually worried about. So for the volatility trend strategy at VTS, this is one of the things that makes it so unique. Like I said, there is no upside risk, but it is still a short volatility strategy. This strategy checks both of these conditions. And another thing that we can highlight is that it actually also performs well as just a standalone strategy. So again, this is extremely unique. To have something that basically outperforms the S&P 500 on its own, but it also has a negative correlation to the S&P 500. This is something you won't see anywhere else. Like I said, strategies that perform well in bull markets and when stocks cooperate, these are a dime a dozen. Trust me, your portfolio does not need any additional exposure to things that work well when stocks go up. The real value added is to have something that can perform well when that's not the case. Now, our Iron Condor strategy as well, it has zero correlation to the stock market, and it also handily outperforms the stock market. So we've got two allocations in our portfolio that are zero or negatively correlated to both the rest of the portfolio and to the stock market. And then, of course, all five strategies significantly outperform the market, and that's when you combine all of them together in a diversified portfolio, you end up with the results that we have gotten. This is how we've made 20% a year since we launched over 12 years ago. But now let's talk about what this strategy actually is, and you'll get a better picture for what's going on here. So of course, everybody knows the UVXY, and this can also be done on the VXX as well. We do that from time to time. Right now, the UVXY has done its reverse split, so the price is up high enough. We can go ahead and do our butterflies on this. But when the UVXY gets in that sort of $10 range and even below, it's no longer viable, and we would switch over to the VXX at that point. But doesn't take a genius to see that the UVXY goes down, so we do want to short this thing. But essentially what we're doing here, the first thing that I want to show you is just a standard butterfly on the UVXY. So you can see the UVXY price is right there, just over 28, and we know that this thing is going to decay most of the time. So if we're going to do just a standard butterfly like this, we want to put that profit range down below where the current price is, so that over the next couple of weeks it can decay down and we can actually make our profit. This is a standard butterfly where it's equal distant from the center strike. You can see two shorts at 27 and then a long at 28 and 26. But watch what happens when I drop this 26 down to 25. You can see the picture now. What I've essentially done, the middle profit range is still the same. It's still there. But I've transferred some of the risk from the high side and I've put it all down here on the low side. Now what this means is it is still a short volatility strategy. I still do want the UVXY to decay down over the next couple weeks, but no matter how high volatility goes, there is no loss on the high side anymore. And in fact, in this case, because it's a small credit, there's actually a gain. So this is a short volatility strategy with no upside risk. Now, obviously, all trading strategies, no matter how good they are, there is going to be a weakness. There's going to be a market environment that is not conducive to profit. And in this case, you can see it. It's down here. In the event that the UVXY not only decays down how we want it, but it decays so far so fast that it actually enters the max loss range, well, this is where this strategy suffers its losses. But the benefit here, and why it's an overlay, is because if that were to happen, we've got three strategies that are net long the market, net short volatility. So tactical volatility, defensive rotation, and strategic tail risk if the UVXY did decay so far that this trade actually lost money, all three of those other strategies would make far more profit than this strategy lost. You can see why there's an inverse correlation here. The only way that this trade can lose money is if the rest of our portfolio did extremely well. Those gains in three strategies would far offset the loss in this one strategy. So trading them together side by side, it does mean that all the strategies could profit at the same time. But the benefit here is that all four of them can't lose money at the same time. These three are tactical. They do actually rotate into safer positions. So this is our daily email. You can see here, when the market is cooperating, of course, we will be short volatility. But we can quickly rotate into safety, which is gold, or long volatility in a crisis. Defensive rotation is the same. It's in 2 times the NASDAQ during good periods, but it can rotate out into utilities for safety and then full cash during a crisis. And strategic tail risk, this one is in the S&P 500, but it rotates out into the real estate ETF and then also long volatility during a crisis. But again, the reason that it makes an overlay is because this strategy does not add any additional risk to the rest of the portfolio. Now, the next question that people will probably be asking is, well, how do you do the strike selection? So I don't give away all my secrets on the live streams, of course, but I can go over a couple of things that will give you some idea. How do I know how far to lead this trade down? Right? Because that's what we're essentially doing. The UVXY is going down. We want to know how far to lead it going lower. So one of the things that we do, again, going back to my daily email, you can see in our volatility dashboard, if I scroll down here, where is our dashboard? Right here, based on all the current volatility metrics, what I'm talking about is the VIX futures, the cash VIX, volatility risk premium, a bunch of volatility indicators, I can actually determine how much the UVXY is currently decaying right now on a daily basis. And then we can extrapolate that out to 5-day, 10-day, and 21-day. So this is our full crush surge dashboard, updated every single day in the emails. For anybody who is an option trader and they're looking for that 1 week or 2 weeks or 21 days, which is 1 month, those option cycles can be predicted based on where the VIX futures currently are, based on where all of these indicators are showing. So that's one way that it can be done. The second thing that has influence for me, and again, I do far, far more than just this, but this is what I can share publicly. I can actually calculate the long-term averages for how much the UVXY decays. So you can see here a rolling 13-day change. This is 13 trading days. Now, where am I getting that 13 days from? Well, if we go to the volatility trend lesson, there's actually a lesson in here. Where is it? This one here, rules of engagement. If we click this, we can see all the rules for the strategy. And one of the rules, scroll down to that one, is, where are you at? This one here. We target 11 to 22 days to expiration for these trades. So of course, I run the numbers and really do extensive analysis on how much these things decay, but this is showing the dead even average between that 11 to 22. This is a 13 trading day average. We can see sometimes the UVXY spikes up violently, but most of the time it is below that 0% level. And we can actually get even more specific. We can divide this into what's called deciles, 10 equal percentiles showing what is most likely to happen. Now again, UVXY can spike up very violently. That's why when you're trading short volatility, you want to have risk management in place. This is going to come out of nowhere. Anybody who thinks they're going to manage it in a crisis, they're fooling themselves. It's actually going to happen extremely quickly, and if you don't have risk management ahead of time, you're going to be in huge trouble. You know, don't forget, someday there's going to be a flash crash, there's going to be a cyber attack. Obviously, you don't want to have undefined risk when you're shorting volatility. But with the volatility trend strategy, there is no high side risk, so we don't have to worry about any of this. The only thing we have to worry about is this down here, remember. Below about the 20th percentile, we're talking about a 19% decay over 13-day periods. This is the thing that's going to worry us because our profit tent is this green area. Remember, we are setting up the trades so that they look like this. We've got no risk on the high side. We've got a nice green profit range in the middle, and we're really only worried about those extreme moves. But one of the other rules that we have is this one. The second rule, we don't initiate new trades when there's potential for a large volatility crush. So again, there are certain times when this strategy will not take positions. It's actually easier to see on this chart here, so let's go to this one. If we zoom in, for example, well, you wouldn't want to be opening trades here because whatever's bothering the market at this time, as soon as that gets resolved, as soon as there's some good news headlines, you can get a massive flush down of volatility. We call that volatility crush. You don't want to enter new trades when there's large probability for volatility crush. You want to wait for that initial flush down, and then you can initiate your positions. And this is one of the ways why we can basically avoid this area over here, because we're not even going to be trading when that's most likely to happen. We're not going to walk headfirst into a 30 or 40% decline. Those only happen after a volatility spike when there's massive volatility crush waiting for us on the other side. We can just set up our trades to say, look, we're probably going to be in this profit range. We do want to avoid this. But the benefit here is that during those periods, like let's say up here, volatility is very elevated at that point. So not only do we want to avoid the volatility crush, but you got to remember that all three of these strategies will also not be allocated to net long equities, net short vol. Those will all be in their safety positions as well, avoiding the trouble. So again, the reason that this is such a great overlay is because this strategy will only ever be allocated when these three are also allocated. And we can avoid this worst of the low. So really what we're facing is we can only ever lose money when the portfolio makes money. We're just leading it down, right? The old Wayne Gretzky thing. I'm a Canadian, so hockey's kind of in our blood. But Wayne Gretzky says, I skate to where the puck is going to be, not where it's been. That's essentially what we're doing here. We're only initiating trades when the rest of our portfolio can handle a losing trade, and then we're also leading the puck to where it's actually going. We're not skating over here to where it's already been. You can see we actually have a live trade on right now. It's this one here. This is in our portfolio right now. And we are currently right now long the SVXY, long the 2x NASDAQ, and long the S&P 500. Plus, we're in 2 market neutral iron condors. So really, do I actually care if the UVXY goes from here all the way down to here? Well, a little bit. I mean, I'd prefer maybe it went somewhere around here. But if it did go all the way, I mean, the other strategies that we've got are going to make way more money than this thing loses. It's going to be 3-to-1. So this is what actually satisfies that condition that I said, that the overlay strategy should have negative correlation and it should not add any additional risk to the portfolio. But the second condition I want to cover is, how do we do this so it's only utilizing small portions of capital? And like I said, ideally, no additional capital at all. How is that possible? So again, there's another lesson in the portfolio. Let's go back to that one. I think it's lesson 3. Yes, what is an overlay? I actually covered this. So if you're in a margin account, you basically don't worry about this at all. Technically speaking, each one of these butterflies is only allocating a 1% allocation per trade. You can see it up here. Here's the trade. Allocate 1% of net liquidation value. So in order to produce this trade that is live in our portfolio, it only uses 1% of our net liquidation value. This is what I mean, that you can actually add a strategy that produces significant return by only utilizing 1%. And there is actually room for 2 trades, so it could be at most 2%. So you might think to yourself, well, how come it says 0? How come it doesn't say 2% here? Well, I covered that for the cash account people. Now, this is more rare, but if you are in a pure cash account, it is actually technically possible to have some allocation required. But let's go through this really quickly. So tactical volatility will use 25, defensive rotation 25, strategic tail risk 25. Iron condors, you can say 3% each for 9%. So the iron condor strategy, technically speaking, has 3 available layers. Now, we don't often use the 3rd layer, but it is there and it is possible. So that's 9%. And then we also have a 15% idle cash allocation for SHV. That is also shown here. You can see 15% here. This is just short-term fixed income because iron condors will never be using up the entire 25%. But now if we add all of this up, that's 75 plus 9 is 84 plus 15 is 99. So there is room for a 1% trade. So even if this is fully allocated and even if all the strategies are fully in, even in a cash account, there is still room for 1% trade, which is totally fine. Now, in the very rare event that all 3 condors are open and both of these volatility trends are also open, technically speaking, you could have violated by 1%. right? I said here, this could put you 1% over. Now, it's very rare. And the thing we also have to keep in mind, there's going to be inefficiencies. We always round everything down. So every iron condor, we don't buy 3.7 contracts. We round down to 3. There's always going to be a rounding error to the good side. Same with all 3 ETF strategies. There's always going to be rounding to the good side. So technically speaking, there probably should be an additional 1% there. But if you're in a cash account and if you're actually worried about this, then you could adjust your 15% allocation down to 14. That's one of the ways that you could do this. You could just say, look, it's not actually a total complete overlay. I'm going to take 1% from the Iron Condor SHV position, or you could also do SGov, you could do BOX, you could do many of the short-term fixed income ETFs, but you could just forego 1% there. Foregoing 1% of a fixed income ETF that's making 5% a year, we're talking about a rounding error at that point. Obviously, I would much rather add something like this than get an additional 1% of a 5% per year fixed income ETF. But that's how it's done. That is how we satisfy the second condition, that we also don't utilize any margin to take this strategy. So whether a person wants to do it or whether they skip it completely, it is the exact same portfolio other than the volatility trend strategy. I would imagine most people, they actually want to trade it. But we do have members in our community that want to keep things as simple as possible. Or they might just not like option trading for whatever reason. Now, you don't have to be intimidated. This is actually extremely easy to do. I would like to think that my trade instructions are very detailed and I explain everything. I'm always available through email. There's courses, there's blog articles, there's videos. Option trading is not something that you need to be intimidated by. But there might be a few people that just say, look, I don't really want to do that. And that's why in the actual daily email, I label this completely optional. If you want to just skip it completely, just look at it and say, yeah, I don't want options. I don't want to figure all this out. Again, it's easier than you think. But if you want to do that, that's completely fine. It is not going to affect anything else we do. This is a 0% overlay for the volatility trend strategy. But if you want to dive in and learn all about a short volatility strategy with no upside risk, again, extremely rare. You're not going to see this anywhere else. You're not going to see other people talking about this stuff. This is VTS only until there's a bunch of copycats, of course. But go ahead and dive in and I will be happy to explain. I will answer all your questions. Trust me, you can do this. Anybody from any background can be a great option trader. You don't have to be a math whiz. You don't have to study a bunch. Just take 1 or 2 trades and you'll understand what's going on. So that's it. Hopefully that's a really decent example. Like I said, there's a free trial. There's a full course that you can go through step by step. And of course, if you're in the community, I'm sending out those trade signals. You can actually take the trades with us live. Again, it's not going to take more than 1 or 2 before you realize what's going on here. Calculations are easy. There's no complex math or anything. Don't worry about that. But I would encourage people to take the free trial, at least for a couple of weeks, and check out what we do at VTS. So of course, thank you very much for listening to that short presentation. And now I want to get into the open Q&A, but I'm just going to play a little 1-minute clip and then go ahead and populate your questions. Trust me, I will get to all of those. Hey everybody, so please just allow me 1 minute of your time to introduce my work, and then we'll get right into the live Q&A. So I launched VTS in January 2012 with 2 main goals. First, to crush the financial industry and help investors start making real progress towards their retirement goals. And secondly, to provide that outperformance at a much lower cost. A low monthly subscription fee scales far better than paying a traditional percentage of assets. Now, our portfolio is currently 5 strategies with low correlation to the stock market and to each other, so it's a completely diversified total portfolio solution. It's also not active day trading, and trust me, anybody from any background can follow in just a few minutes a day. Since retiring from pro golf in 2005, I've been an options and volatility trader for 18 years now, and I share a lot of invaluable volatility data from our dashboard in every daily email to subscribers, so you can learn the same tools responsible for my success. I'm also a certified workaholic, and there's a growing list of courses that all members have full access to. There's a free trial to VTS available to everybody down in the description below or on my website. Come join members from almost 70 countries around the world. I can definitely help you achieve your financial goals. Now let's get into the live Q&A. Okay, so hopefully everybody has their question in. We're going to get to all of them. I noticed a couple of people said the audio was off. I never know when to stop. I can kind of look at the corner of my eye and I can see the comment section as I'm doing a presentation. I was basically just waiting for one more person to say something. So I don't know. Hopefully it was okay. Nobody was really screaming at me to stop. They can't hear it. They just said there was some type of interference. The only way I'm ever going to know that something's wrong is if I watch the rebroadcast later. But, as I was, doing this, I'm looking around, everything kind of looks okay. So I really wouldn't know how to fix it on the fly anyway. I hope it's fine. We will see. But go ahead and shout in the comments if you really can't hear me. Otherwise, whatever's bothering the audio, I just can't think of anything. But yeah, I'll figure it out. I'll watch the rebroadcast. So there we go. All right. So let's go top to bottom. Of course, you can ask questions about the stuff we just talked about, the volatility trend strategy, and talk about anything else. Where's my off-topic questions if you feel like you just want to chat and hang out? But here we go. Get rid of that. Okay, George says, looking forward to the session. Well, hopefully you learned a little something about the strategy. Thank you for showing up. Audio's off. Audio's weird. Sorry about that. All right. UVXY Butterfly can be worked on alone, or does it depend on having long equities positions? What are the CAGR and maximum drawdown of the strategy alone? So we kind of went through that, but you probably asked that just slightly before. But if you're looking for the actual strategy, yes, it can be traded as a standalone. The only thing about this strategy is there is going to be, I don't want to say extended periods, but there's going to be plenty of periods where we're not in any trades. It's just kind of the way that it functions. Remember, I presented like this, that we're really trying to avoid those periods where the UVXY can decay significantly. So anytime we're in a period like that, it is probably a good idea to avoid those. And, that's going to happen when volatility has the probability of crushing down. So roughly, I don't know, I want to say maybe 1/3 of the time, we might actually not be in any trades, maybe even half the time. But to get to your question as well, it does help a little bit when you're looking at a trade like this, knowing that if you get a losing trade, like I said, the other 3 strategies are going to be winning, like basically by mathematical design. It would be nearly impossible for the UVXY to go down here and for the stock market to not be going up. It is literally impossible for the SVXY to not be going up. So we've got at least one strategy that is quite literally mathematically impossible to lose money if this thing goes down. And then the other 2, again, I mean, it would be the most bizarre incident in the world if UVXY went down 20% and the stock market didn't also go up. So of course there is going to always be that benefit if you are allocated to net long equities already or your short vol already, then you can basically just put these on at will and not really worry about it. But yes, it can work as a standalone as well if you really want it to. You'd probably want to target your entries and exits. You'd want to scrutinize them a little bit further because you don't have that offsetting profit. I like to trade these when I've got at least one of our strategies allocated, and then as soon as there's 2, then it's just green light. And if there's 3, you can go ahead and put 2 layers on if you'd like. So that's kind of how I use it. All the strategies could function as a standalone though. So yes, that's fine. Okay, cool. Audio's better now. The worst part about live streams is the technical difficulties. You can never tell, right? Internet's all messed up. I do set it up the same every time, I think, but I don't know, because I mean, of course I can't hear it. I don't wear headphones. I've tried it once and I hated it. It was so hard to do a live stream when I could kind of hear other stuff. So it is what it is. I can't take my phone in the MRI on the afternoon the contracts expire. What's my best strategy? So by contracts, I would assume you mean either the iron condor that we're in, both of them, or the volatility trend that we are in. I would say, you said afternoon. The only time that you would have to close something out after my email, because remember my email goes out roughly 11 a.m. So I suppose you're saying maybe you can check the email and then you lose access to your computer. If it's on a Friday, we actually do have to close out all broken wing butterflies that have in the money strikes before expiration. So you can see that this is a long put option. The 27 is 2 short put options, and then the other one is another long put option. So the UVXY is priced right here. If it expired, like let's say this was the last day and its expiration, this contract right here would be assigned. And you definitely don't want to take assignment of any of these options. So if there are in the money options, you do have to close it before expiration. So if you are talking about you're going to lose access to your computer in the afternoon on the Friday of expiration, if that trade is anywhere close to the money, which it very likely will be, right? Remember, the UVXY is going that way most of the time. Yes, you should close it out while you have access to your computer. Don't want to wait until the end of the day and realize over the weekend, and then you come back Monday and you're assigned a bunch of shares. You don't want that. Not only because it can really mess with your margin, but it can also be pretty bad. Like let's say you're assigned a bunch of short shares. You know they're coming. Over the weekend, your broker is going to give those to you and they're going to be in your account Monday. But maybe you see the futures open and it's just skyrocketing, right? Something terrible happened over the weekend. You could be facing a significant loss. So absolutely, if you don't have access to your computer, you need to know that these have to be closed before in the money options are even close to it. And even if it's close, I would just err on the side of caution and just close it anyway. Trade fees are very low. It's really not worth the hassle. Don't try to nickel and dime those trade fees thinking, well, I don't technically have to do it. I think it's going to be okay. If it's at all a question, just close it down. It's fine. Even a day early, it's fine. Okay. Would you ever trade broken wing butterflies on stocks? Yes, you can, of course. So the key to the broken wing butterfly, the reason that I like this trade so much, so let's pick a stock. Let's pick everybody's favorite stock, Tesla, right? This is everybody's favorite, right? So if you were to trade Tesla, for example, one of the things that you can do with broken wing butterflies, let's say you're going to do this one right here. You're going to buy this butterfly. And the price of Tesla is right there in the middle. So let's do the 170, 180, 160. So this is a trade for a person who thinks Tesla's not going to move, right? They don't think it's going to go up or down. They have no bias. The great thing about the broken wing butterfly is that you can still skew the trade, but not be completely directional, right? When you're buying Tesla, you're basically long or short. This is extremely binary. There's not a whole lot of wiggle room there. You have to draw a line in the sand. Do I think it's going up or down? With a butterfly, you can play for it's not going to move very much either way. This is a fine trade if you have zero bias at all. But if you have a bias for the trade, you can adjust one of the sides. I don't know which strikes on Tesla are available. Is there a 77.5? Something like this. So where, yeah, maybe you have a slight bias that it's going to go up, and you basically want to transfer all the risk to the low side because you really don't think it's going to go down, right? You could do this where you're not entirely directional, right? You're not going to get hammered if you're wrong, and you're going to make a little bit of money if you're right, but basically you want it to hover around somewhere in the middle still. It is sort of market neutral-ish, okay? You could do that, or you could go the other way. Let's say a person thinks, well, you know, I have a slight, oh, look at that. Oh, it's not traded, so that strike's not available. You could do something like this. Again, let's just say that you're kind of neutral on Tesla, but you think, you know, gun to your head, if you had to pick a direction, it's probably better off, it's probably going down before up. Then you would do something like this. You're still neutral, you still don't want it to move a lot, but you're comfortable transferring the risk from here over to here, because maybe you really don't think it's going to go that way. So yes, the broken wing butterfly extends far beyond just the volatility trend. But the reason that I like that strategy with UVXY so much is for all the reasons I mentioned. The 1% allocation, the fact that it's mathematically negatively correlated, it's an overlay, it's a short vol strategy that has no upside risk. That's almost unheard of. That's why I transfer it basically to that. But what I just showed you is essentially what I call the directional fly strategy. And some people in the VTS options community, when we were doing that, you know, it's been a couple years now, but we had a full options community as well. They will remember the directional flies, where it is like that. Sometimes you want to be neutral, but you have a slight bias one way or another. If you do have a bias, well, first of all, if you don't have a bias, you could just open an iron condor. If you do have a bias, you break one of the wings in the direction that you think it's less likely to go. And probability-wise, that's a pretty good thing to do. Like, we're all wrong when we trade, but you can put a little bit of bias into each one of your positions, and it's better off long term. I would say what you don't want to do is you don't want to be the type of trader, which the vast majority of people are, just drawing that 50-50 line in the sand saying, oh, I think it's going to go up or I think it's going to go down. That's a real commitment, right? You could be wrong. It could be balancing somewhere in the middle there. So I like directional flies for that reason. You can basically put the risk where you think it's least likely to go, knowing that you could be dead wrong and it might actually go exactly there. You wouldn't lose that much in that case. Okay, Johnny Tube U. More questions. Who's going to win the Stanley Cup? I have no idea. I don't really watch hockey all that much anymore. I grew up playing hockey, but in the last, 15 years or so, I haven't really been that into it. I'm a longtime Boston Bruins fan. The Bruins are pretty good again, so I'm going to go with Boston. But I don't know. I really don't know. All right. Would you talk about the terminology of the portfolio strategies? Why is QQQXLU considered defensive? Yeah, it's not. Why is SPY IYR strategic? So tactical volatility makes sense, right? So I don't really have to justify that one. Let's shut that guy up. Tactical volatility makes somewhat sense, right? Because we're tactically rotating between long and short vol with a position in the middle, so that's good. This one probably makes the least sense. I just thought it was kind of a cool sounding name. Just marketing perspective, you have to make something sound, I am all about risk management at the end of the day. So I thought, defensive rotation, the fact that it's rotating defensively into utilities. I have shown in a million videos and live streams in the past that the number one best defensive position for the stock market is utilities. So that's kind of where that name came from. Strategic tail risk is easy because this is designed to be our main tail risk strategy. This sliver right here in the long volatility will probably trigger about 1% to 2% more often than this one will. This one is only, I think at last I checked, it was about 2.6% of the time we're in long volatility. This one is closer to 4%. So strategic tail risk, that makes sense. Iron condors and volatility trend. I don't know. That's how I named them. At the end of the day, it's marketing. You have to come up with something that sounds kind of cool, and hopefully I did a reasonable job. But I don't know. I'm a terrible marketer. As you know, I've never done an ad. I've never done any marketing. I don't really have a newsletter. I don't do any of that stuff. I just make content, put it on my website, put it on the YouTube channel, and people find me. So if I did targeted marketing and I really started to focus in on selling ads and whatnot, I'm sure I could do far better, but I just have never really cared about that stuff. I just share my work, and if you like it, great. If you don't, we can still be friends. All right. This is another one. You asked about 5 questions today. Also, will you talk a little bit about the change from T+2 to T+1 settlement period that most brokers are now adopting? I don't know why it's not T plus instantaneous. This is just an archaic system from the past when way back when they used to actually use paperwork essentially to do this. But given that we are working with computers here, I guess moving to T+1, what he's talking about is when you make a sale of a stock, there's basically a settlement period before that money is available to make another purchase again. But it blows my mind that we're still using some archaic system here, but it is what it is. T+1 is an improvement over T+2. UVXY spreads since reverse split have been excessive. What do you mean by excessive? Like larger premium than you were expecting? An easier trade than you were expecting? I have personally noticed that the premiums are decent, but I would probably credit that more to the fact that the market is just now recovering a little bit. So what you will notice just long-term in general is the best premiums. Let's go to something a little bit longer. So this is a SPY. The best premiums will come when the market is in that initial recovery phase. By the time you get to the second part of an extended, good period in the stock market, I suppose you could say people are starting to catch on. The options market is pretty efficient, and those premiums start to balance out to the point where it gets to the point where it's kind of a crowded trade, to be honest. So right now, I would credit it, if that's what you're saying, because I've noticed that the premiums are slightly better than they usually are. It's probably because of this, not because of the reverse split. The reverse split, like I always say, the options market's efficient. I sure hope that most of the people who are trading options on volatility ETPs, that they're sophisticated enough to know that the split literally does nothing. Like it should not affect anything whatsoever. I'm hoping they're sophisticated enough to know that reverse split doesn't mean a whole bunch of people are going to take a certain type of trade. Nothing happened when the UVXY went from 7 up to 30. Nothing happened at all. It's just a reverse split. So I would say it's probably because we're in that first wave where a lot of traders are probably still doubting this recovery in the stock market. And if it goes on a little bit longer, people are going to start catching on. They're going to start capitulating. They're going to start realizing, well, here we go, short vol, it's just going this way and everybody knows it. That's when the premiums start to diminish a little bit. So right now probably is a decent time to open anything that options related where you are on the net credit side, I would say. Okay, here we go. I missed one that said Gretzky rules. Yes, Gretzky rules. But I'm from Calgary, Alberta, and Gretzky played most of his career, at least for 4 Stanley Cups, in Edmonton. So Edmonton and Calgary had this massive rivalry. So, of course, when I was in junior high school, this is basically when Gretzky was, winning all the Stanley Cups. It was brutal because back then, I guess because I was from Calgary, I was a Calgary Flames fan, and the Oilers fans were absolutely relentless. So I still remember those days. But yeah, Gretzky's the man. There's no sport where the #1 greatest player of all time is so clearly defined. I mean, it's so obviously Wayne Gretzky in hockey, whereas you could say Michael Jordan, LeBron, it's close. Some people throw Kobe in there. Whoever, there's, you could go back to Magic. You can go, there's so many players that you could say. Kareem has the point scoring, going all the way back to the old days. Other sports like baseball, who's the best? I don't know. Football, it's kind of close. Tennis, there's 3 guys, Federer, Djokovic, Nadal. Hockey's just, it's Gretzky, with a bullet. There's no doubt whatsoever. Even if Ovechkin actually passes him in the scoring, the points, the total points, the cups, the impact on the game, I mean, he's by far and away. So now let's get back to the volatility stuff. How is VX30 to VIX roll yield calculated? Trying to make me share my secret stuff here. And is its margin of error usually on the upside or downside? That part I don't understand. The margin for error. In the calculation? So I don't need to be overly secretive about this. The VX30 to VIX roll yield is essentially trying to calculate what is called the 1-month constant maturity VIX future contract. So you can see right here, the front month VIX, it has 11 days to go. The back month has 39. If you were to look at, let's just open any spreadsheet here. Which one should we open? Let's open this one. You can always tell how many days to expiration for the front month and the back month, and you're basically just doing a calculation to try to figure out what they are. So essentially, if there's 11 days left, you're just taking the front month VIX future, you're multiplying by 11 days times that percentage of the daily roll. And then the back, you're adding to it the second month future multiplied by basically 100% minus that, daily percentage. So let's see if this spreadsheet actually opens for me. All right, that cooperated a little bit. Usually they freeze. So what are we looking at right now? 24 days, it's decaying. Oh no, this isn't updated. This is April. I don't have the May, but basically this is a different spreadsheet entirely. But basically 4.17 for that cycle, you basically only have to do this future times 4.17 times 11 days, and then this future times 100% minus 4.17 minus the 11 days. You're just taking an average to get the VX30. It's not overly complicated. There will be, of course, a video going over this in much more detail. It's not a secret. I do want to share that. That's what those new courses that we're working through, that's what they're eventually getting to, is there's going to be a spreadsheet that people can download and all that good stuff. All right. 10 more questions. Where are we at? 45 minutes in. I do try to keep these an hour. Okay, here you go. You clarified. Awesome. Margin of error as in predictive power over price. Sorry, I'm not getting it. Are you basically asking me how successful it is in predicting? On any top 5 list of the best volatility metrics, you're going to find something to do with the 1-month maturity contract over the VIX index or under the VIX index based on how many days to expiration. This is basically central to the volatility trade. If you don't know that, if you're not tracking it daily and you're not calculating a bunch of things related to the VX30 in relation to the VIX index, I don't know what people are doing. I really don't. So yes, if that's what you're getting at, it is extremely important. And as far as margin for error of predictive power, as small as could be, right? No trading is just Nostradamus looking forward, right? It's wrong all the time. We're just trying to maximize percentages here, but it's pretty solid, right? As good as anything else there is. Put it that way. I probably messed up your question. I don't know. Your thoughts on shorting biotech pre-release clinical trials? Hedge or just go to outright short sell? 1 of 9 pharma success. I don't know what that last bit means. Maybe you're talking about how you only have to get it right once out of 9. I don't really know what that last bit means. But this isn't a trade that I do. I don't do any guesswork. I don't do any market predictions, as you can probably gather from just checking out the live streams of my portfolio. All of this stuff is calculated, it's systematic, it's all rules-based. Even the options are technically discretionary, right? I am choosing the strikes, the expiration, but as I pointed out in that courses, there is a long list of rules that I follow. So everything is systematic. And certainly with the 3 strategies here, it's 100% hands-off. I just enter all my data and then there you go. It tells me what to do, right? So essentially, kind of sounds weird if people aren't familiar with systematic trading, like quant-based trading, but I don't know what I'm trading either. The spreadsheet tells me what position I do, and then I communicate that to the rest of the community. So none of us know what the trade is going to be on Monday, right? I have to input all the data. It takes about 30 minutes. And then I'm going to be like, oh, look at that. I guess I'm going to be short volatility, right? That's kind of how it works. So if you're talking about doing all this, based on press releases, based on earnings, based on, things like that, pretty much you're going with your gut instinct on those. And I don't like to take those trades. But I kind of read a lot into that 1 of 9 pharma success. But if what you're saying is sort of how I read that, I think the one thing you might have going for you is you don't have to get it right all the time, right? This tends to be a very asymmetric trade. So as long as you skew it that way, and as long as you take a conservative position, you don't have to be right very often in order for it to kind of pay off. I guess it's similar to the long volatility aspect where, if you're waiting for the market to crash and then you're going to be sort of a trend follower like I am, once the volatility metrics get into those really high percentiles, that's when we go long volatility. Now, it's true that is also a period where it oftentimes fades back down and you end up taking a small loss, you get out of the trade and you go back to the other safety or go long the market again. But 1 out of 4, 1 out of 5, 1 out of 10 really big ones, all you got to do is call the odd rare one and you get that recession signal and you can make far more than just the little paper cuts along the way. So maybe you should try to set up your trades that way, that if you're going to be playing these biotech stuff, do a lot of them if you can, try to get the trade frequency up more. And then I see nothing wrong with this. As far as what position, I would do everything with options because I would want to define my risk. Shorting, I would imagine that the short fees are high, really high, and can change. So don't try to dance right on the edge of your margin requirements, because you might wake up the next day in a margin call, then they basically doubled the margin requirements because some big event is coming. They can do that to you. Yeah, I would just do probably vertical put spreads. That's always a pretty good default. Defined risk can make a lot more if you skew it. Like, let's say it's trading at $100. If you did like a 75-50 put vertical spread, right? You make it out of the money, so you get that convexity, and then you also spread out the strikes more. You can actually make a lot more than you put up. You might put up, $1,000, and you could get back 5 or 10,000 if you're right. So I would do that. Well, I wouldn't do that. This isn't a trade that I take, but there's nothing wrong with that. I actually have a strategy that I kind of mess around with, and I call it the lotto ticket strategy. It's similar to that. I just wait for opportunities that I think, well, this isn't really my game, but I want to play this one. And that would be a lotto ticket strategy. All right, didn't get here at the beginning. No problem. It's online forever now. If this was covered, but is there a profit target loss for the overlay butterfly? So it is in the lesson. There is a lesson that's covering why we basically take these trades pretty much to expiration, very close to that. So the way that the butterfly works, it's not the same as an iron condor. So we do have some live iron condors on as well. An iron condor can make money faster. Okay, so it's basically a short Vega trade. It can make money faster. So with these, we do use stops, and we just make them 50-50. With iron condors, you can see that the way that we set them up, very wide body iron condors. So they're really safe. They're slow moving. You can react. If the market crashes, the gamma risk is low. The delta is moving slowly. But you can see that the loss is much larger than the gain. But we use a 50% stop loss, 50% stop gain. So from my perspective, even though the expiration is lopsided, from my perspective, this is a 50-50 trade, and I just have to get more winners than losers. I don't look at the expiration because I'm going to close this. It's still going to have more than a month to go by the time I actually close this. It's going to hit one of the two stops, right? And then the other one we did is this one. This one is kind of a newer trade. Just put it on recently. What am I doing? There we go. That's the new trade. So iron condors can actually get to their stop losses reasonably quickly, whereas the butterfly, just based on the structure, it actually requires getting quite close to expiration. Let's say the UVXY bled down to here, and it was at the perfect expiration point, but there's still about a week and a half to go. The profit would be, it could be negative at that point. But as we get closer to expiration, the theta will grow exponentially to the point where that number gets big pretty quickly in the last week of the trade. But these ones take a while to ramp up. So I basically don't even look at them. I mean, it was 29.40 or something when we opened this trade a few days ago, and now it's already down to here. I'm not even going to look at this because it might go all the way to here, and then all it takes is one bad day and it's already back in profit range. There are other times when nothing's happening, it's not budging at all, it looks like, wow, this is going to be a losing trade, and then all of a sudden you wake up the next day and it's volatility crushed down into the range. Now, obviously the same can be said if it's looking really good. It can crush your dreams on the last day as well. Obviously, be aware of that. But I let these go quite close to expiration, to answer your question. We do need that structure. Just the way that it's skewed with those Greeks takes a lot longer than an iron condor to actually realize that profit. So just get used to taking them 1, 2, 3 days before expiration. Take a peek where it's at. Big profit. If you feel like taking it, you can take it. We rarely close them out before maybe 2 days. Yeah, it's just a very small 1% allocation, and let them go. See what happens. Layer a bunch of them. Law of large numbers, high trade frequency, and it should all work out. Definitely a lot more winners than losers. Okay, for VXX long put, to make it a vertical spread, what delta should be used to select lower strike? I don't know what you're saying here. So you've got a long put on. I mean, I don't know what your trade thesis is. I have no idea. I don't turn long put options into vertical spreads. So if you're asking me in general, just setting up a vertical, what delta should be used? It totally depends on your trade thesis, right? If you're trading something like UVXY, of course you're going to be well out of the money, right? Because if you go at the money, you're going to get terrible premium for that because, you know, pretty much everybody knows that this thing's going down. So you'd want to lead it a little bit, and you'd want to have some type of timing edge to make sure you're not just randomly buying long put options. That's not going to work long term. But there's plenty of times when you would adjust the deltas to be really low, right? If you wanted a larger payout, or you could do higher if you wanted a slower moving trade. You could do short term, long term. Sorry, I don't know what your trade thesis is. So we've got a few minutes left. Maybe you can clarify if you're still hanging out with us. Okay. Did I lose my spot? Here we go. How would you mimic the UVXY broken wing butterfly from your example, but using VIX futures? I wouldn't. We don't trade futures. I don't like even talking about futures because the more things I talk about, the more questions I get. And I have to be extremely careful to, whenever possible, keep things simple. Now, of course, things can be replicated with futures, but it gets a little bit tricky when you're dealing with multiple legs. Like the best way to trade futures would be something like a calendar, right? Where you're dealing with two different monthly cycles. Of course, then it transfers over easily, but I've already said too much. I really like to avoid the futures conversation whenever possible. We trade ETFs mainly, and for people who like the options, we trade those as well. Futures, you're on your own. It's kind of the same thing. I mean, honestly, they're very similar, but I just don't want my email inbox to be a nightmare tomorrow. All right, sorry, I'm punting on that one. No futures talk. Do you use the metrics like the ratio between TDEX and SDEX in your calculations? Not those two together, but the TDEX itself and the SDEX itself, they are informative to a point, right? There's another thing that we used to focus in on. I haven't mentioned it much because we don't do as much option trading anymore, but the VIX minus volley ratio is somewhat similar to what you're talking about here. So this one, VIX minus volley residual. The VIX index is measured based on a strip of all option strikes on the S&P 500, basically 30 days out on the SPX. But the volley is basically the same thing as the VIX. It's just using at the money strikes on the SPY. So if you just subtract them, you are left with a residual number that represents the out of the money options activity. And based on how high or low that is, you can actually derive some pretty good information from that. So if you're talking about something like the TDEX, which is basically the standard deviations out of the money, it's kind of doing the same thing. So yes, in a nutshell, they are quite instructive. Now, like you said, the ratio between them isn't something that I don't put it in my daily emails, but yes, I use these a lot. These are the nation's indexes. They're quite good. I like them. Just, it tells you a pretty good snapshot of where the options activity is at any moment. So yeah, I like where your head's at with that. They are good indexes. And to be perfectly honest, the volley is better than the VIX. It's just, there's no way it's ever going to overcome that first mover principle where the VIX has been talked about for decades. The volley is more instructive and probably better. It's just, it's never going to take its place where it probably should be, unfortunately. Okay, there's too many questions to get to. We've got 1 minute and 10 seconds before the hour is up. Okay, I was meaning that 1 of 9 clinical trials ends with drugs on the market. So, okay, well, that makes sense. I totally misread that. But my point about being right 1 in 9, it's kind of similar. And this is kind of getting to that point that you don't have to be right very often to get it, but you're actually talking about shorting it. I thought the better play, and this is not my game. Remember, this is not what I do. But wouldn't the better play to be structuring options to go long, and then hopefully you get one of those that does become that high flyer? Wouldn't that be the way to go? But then again, maybe the price before the trial information is released, maybe the price is really high and you think they're going to have to eventually tell the truth that, well, nothing came of this and it's going to crash down. You're going to have to decide whether the risk reward of catching a high flyer on the upside is better or worse than the bad news hitting the stock on the downside. But same concept. You're probably going to have more fails than wins. You just have to structure your allocation size, position sizing, to make sure that you end up on the right side of that coin. Like win rate is one of these things that people talk about a lot. They try to sell courses, sell services and whatnot. We have a 90% win rate. All you're doing is selling out of the money options that most of the time expire worthless, and 1 in 10 rip your face off, right? That's all they're really doing. Win rate doesn't mean anything. It's the most useless statistic in the world. You can have a 90% win rate and lose money long term, and you can have a 10% win rate and you can make money long term. It all depends on how you structure that risk reward ratio. So that's all on you. I'll let you play the biotech stuff. Why market makers are always short volatility? What if something like COVID happens again? Market makers are, I don't know where you're getting the idea that they're all short volatility. They are offsetting their positions and they're making money off spreads. Yeah, I think that's not accurate. I don't think I would say that they're always short volatility. I would say that maybe what you're thinking is that they're quite often using volatility instruments within their hedging stuff. So hedging with VIX futures, hedging with VIX options, all that stuff. That's the game that they're playing. It's quite common there, but I wouldn't say that they are net short volatility. The market makers they're not really taking directional exposure in that way. They are basically hedging out their risk and making money in a different way. They're providing a market and making money on a different way, I would say. I don't think that they're always short volatility. Okay, what am I looking at here? A couple of these questions seem to be repeating, or is my software weird? Can volatility go to 0%? No. No, because it's all mathematical calculations, so no. The VIX, the lowest VIX print ever was what? 917 or 912, somewhere around there. Closing price, it dipped in the 8s intraday, but I don't think it's ever closed below 911, something like that. It can't go to 0 because variance it's always going to be the case. I mean, if you measured volatility over a single day, like if you were measuring a 1-day volatility, I guess it's technically possible that something could pin and just literally not move for a day, maybe, I don't know, or an hour volatility, possibly. But pretty much every volatility metric is over time. It would literally be impossible that there isn't some variance going on. So no, it can't. But there is a floor. Like it would be useful for people to determine, like let's say you're an iron condor trader and one of your main targets is the SPY or the Qs, something like that. It would be in your best interest to track what's the lowest, say, 5th percentile of all volatility readings going back in time, and what's the top 95th percentile, just so you have some benchmark for how high can it technically go. I mean, infinity, but how high has it actually gone? Get that number. And then, of course, it can't go to 0, but how low can it go? Can it go to 12? Can it go to 9? Can it go to 8? You know, when you're talking about the SPY, yeah, like implied volatility can go into the single digits, but no, it cannot go to 0. So that's not important, but ranges are very important, relative ranges. If the volatility on the SPY is 16, you have to know, is that high? Is that low? Is that long-term average? Where is that, right? That's what... just data mining. Get a spreadsheet out and track everything you can possibly think of. Okay, not a question, but I've been a subscriber to a VTS service for over a year, and it's been absolutely great. I really can't overstate how effective this strategy is. Thanks. Well, I very much appreciate that. Thank you very much. Kind words from our friend Nathan. One more question. I'm 4 minutes over. the market in general is short vol. That I would agree with. Well, I mean, and it's really the case when you actually consider that if you're long the stock market, we don't call that short volatility, but you are short volatility if you're long the stock market. And what percentage of market participants are long the market? A lot. Basically, 99% of the asset management world is short volatility because they're net long equities, and that is a short volatility position. So that I would agree with. I'm just talking about the market makers themselves. They typically don't expose themselves to directional plays like that. It's more about trying to be as balanced and delta neutral as possible. But if you're talking about just in general, how come asset managers are short vol? Well, 99% of the world is always short vol. It's just the way it is. That's why the market goes up. I don't know if it's chicken and egg thing. Is everybody short vol net long equities because the market goes up, or is it because everybody sees that and then takes the position, or everybody takes the position and then it's a self-fulfilling prophecy? Who knows? But yes, the world is short vol. So we are really short vol. We're extra short vol. But like even people who don't even understand trading are short vol. They just don't know how to call it. They don't know the terminology. But yeah, the whole world is short vol, basically. So we're super double leveraged short vol. And long vol when we need to. Of course, sometimes, every now and then, every 5 or 10 years, we can make a killing off the long vol stuff. All right, cool. So I went over by 6 minutes only. I'm getting better at this. It's supposed to be an hour, and it was. And I mentioned the thumbs up, so don't have to do that again. All right, cool. Thank you very much. We will see you again next week.